Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding, sitting alongside Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It is going great. We hope it's going great for everybody else. Hey, we are going to be in New York, November 11th through the 15th, New York City. So if you are interested in what we're doing here at Focus Compounding, want to learn a little bit more about either the managed accounts or the new fund that we are launching, reach out to me at info@focuscompounding.com. We've already had probably a good handful of people that we're going to get on the schedule, so it is filling up fast. So definitely reach out to me. Again, that's info@focuscompounding.com. If you're watching us on YouTube, hit that subscribe button, thumbs this video up. That helps spread the word. And then, of course, if you like the work we're doing, leave us a rating and review, which also helps spread the word. We're trying to hack the YouTube algorithm. Okay. Or the iTunes algorithm. Okay. So in today's video, we are going to be talking. So this week we had sent out a poll on Twitter going over a bunch of different topics, really 4 different topics, to see what people would be most interested in us talking about. And I guess the poll itself turned out not that beneficial because it was pretty equal. It was very close. Yeah. So I was like, I guess we have to do every one of these videos. But in today's video, we're going to be talking about, and if you want to get access to that poll or for future polls, maybe we should do that more often, follow me at Focus Compound. But today we're going to be talking about the secret to snap judgments, why 95% of stocks aren't worth your time, and how to instantly spot the 5% that are. Okay. Very catchy title, Mr. Gannon. Very catchy title. He came up with that. Okay. So let's talk about that. So 95% of the stocks aren't worth your time.
Yeah. That's probably true. Yeah.
And I guess it's easier probably if we could start with how to discourage those 95%. It's probably a lot easier to focus on that than to move or start with why we look for the 5% of the stocks. Okay. So let's start with the 95%.
Okay. So the idea for this podcast basically came from reading a Graham and Doddsville interview with Pabrai. And he said 2 things that were really interesting. One thing he said was that he's very good at making quick judgments about things, but he's not necessarily better than anyone else making slower judgments about things. So that was the thing about snap judgments. But the other thing he said is basically that he looks at 100 companies and maybe 3 of them are good, at most or something like that. Yeah. And that's true. And that's my experience too. You look at a lot of companies and very few.
Now, when you say like he's looking at companies, I mean, what does that mean? He's looking from a bird's eye view. He's looking at like what we may do with QuickFS, the financials. Is that he's actually reading about the companies? I mean, what does that mean?
So it could mean that you're looking at the like QuickFS.net. You're looking at the financials. You're looking at like 10-year summary financials, things like that. It could mean you're reading a description of the business and learning a little bit about it. In fact, in that interview, he talked about a stock that then we talked about, and I said, this is an overlooked stock. We're not going to do it. But I was impressed by how it looked more attractive than I thought at first reading about it. At first reading about it, I thought, it'll make money for a few years, and then it won't make money after that. It's just like a temporary shortage in their industry and their commodity producer, and they'll make a ton of profits in this boom. But then we looked at why there wouldn't be a lot of supply coming into the industry, or why there wouldn't demand drop off just because the price went up a lot, right?
Sure.
So it's things like that. It can be things that are that quick of looking and saying, okay, well, this thing's in a boom. Obviously, new supply will come in. It'll bring it back down. So that's why it should trade at a low PE or something. So you look at that and you go, well, I can see how this is just a temporary thing and it'll go away. Yeah. And there's lots of cases where that happens, where you see something that looks like it has a low PE, but you quickly eliminate it because you realize this is just a temporary profit situation that's having in a moment of shortage and it won't again, So he could be talking about things like that. And I think that's true because in that interview, he specifically says that stock he likes a lot is not one of the 3 out of 100 that are really good companies that you want to hold for the long term. It just was really cheap.
He's just betting on the odds, essentially.
Yeah. So, we talk about the return on equity being good enough, profitability being consistent, that it is able to self-finance, things like that. Yeah. I mean, if you go through, we do a lot of overlook stocks. If you go through the pink sheets and stuff, it's one after another that aren't self-financing companies. A lot of them aren't even really up to scale to start making money.
So when you say self-financing, I mean, how do you quickly look at that?
They basically need to have free cash flow. If they don't have actual free cash flow, because they're capital intensive and they're in the early stages of their growth, then you would have to be sure that the capex is mainly growth capex. And they have to be able to finance before that, yeah.
And obviously probably like low leverage, stuff like that.
Yeah, well, usually it would be low leverage. I mean, you could have a good business that has high leverage, but if the business needs leverage just to operate, if it borrowed to be able to do this, then it's probably not a good business, yeah.
Mm-hmm. Interesting, yeah. And then I guess to, take it a step further, I mean, so when you're looking at these companies and you are looking for things to disqualify, I mean, what is it that sticks out? Because a lot of times the best investments don't screen well.
Okay, that's true.
And you could look at NACO, for example. I don't know if NACO would have screened well when we originally looked at it because the business in the past wasn't going to be the situation going forward for them, right? It was a spinoff. They were spinning off Hamilton Beach Brands. So it was going to be a totally different business going forward.
Yeah.
So how do you, I guess, kind of look past that, if it will? Yeah. And does that come from learning just about the business? And I think, this is what I always say about Geoff, I think your ability to sort of generate the narrative behind the situation is better than a lot of people.
Well, I think that's what Pabrai was talking about.
And you don't get that necessarily from getting a screenshot or a bird's eye view of the company, I feel like.
No, you read about the company for like 5 minutes, focusing on certain specific things, which is what I did in that case. There was a write-up of a company. The company was GraphTech, and I read the write-up, and I read the write-ups at Value Investors Club, at Corner Berkshire and Fairfax, wherever, and a lot of times they go, based on the write-up, I don't really believe what they said is necessarily going to be true. I don't have a lot of high confidence in it, but sometimes you do. You read something. I mean, the example I give all the time is I was reading about George Risk, which is a net. It was at the time it was a net. And I didn't know anything about the company or anything. I had its 10-year financials, but I was just reading it. And in the interview, the CEO said something really weird, which changed my view of the company a lot. He said that their material costs, so what they were paying for the materials that they were then putting labor into to turn into a final product, were higher than what their competitors sold the final product for. So when I read that just, everything else I read was insignificant compared to that fact that he had just said, because I knew they had really big market share in what they did. They're probably the biggest supplier to the biggest distributor, in their industry. So the fact that you could buy a raw material and pay more than your competitors were selling the finished product for meant that obviously the price of the finished product just wasn't that significant. And then I learned more about it and why that might be true. Was it a relatively small percentage of the final product that it was? Are other things important, like is customization important, is on-time delivery important, is, whatever. So, I mean, we talked a little bit about this with the 10K, reading a 10K, what things you need to see that jump out at you, and to focus on those things. And that's what I'm talking about in terms of like making a snap judgment about the business, is that you have to pick up on those things really quickly about whether they're, whether they have a competitive advantage. Buffett talks about this a lot because remember, Buffett decides to make an acquisition often like 5 minutes after hearing about it.
Yeah.
Right? And so he has to read about the business, hear what they're saying about it, if they send him a letter or something like that, and then decide, I want to buy this. Well, the way he can do that is because it's sort of like chess players or something. So the world's best slow-playing chess players are often some of the world's best at super speed chess, like blitz chess and stuff. They're not as good playing really fast as they are really slow. But if you're good at really slow chess, you're also going to be pretty good at really fast chess too. And the same thing is going to be happening with like someone like Buffett. If he studies a company for 5 hours or 5 days or whatever, he may be very good at it. But if you're very good over 5 hours and 5 days, you become very good in 5 minutes at looking at things. You have to, because you've seen so many things, you pick up on those patterns, you know what things to focus in on immediately, and like what things to doubt and stuff that a company will say,
Now, what about like, they say, if, for example, he thinks there's some sort of catastrophic risk, he's just gone, like it's disqualified.
Right, Buffett's that
right?
way, yeah.
So what are your, I guess, thoughts on there, or from that standpoint, to disqualify the 95% of companies that you look at?
Yeah, the reason why we disqualify almost 95% is competition. Much more so.
I'm sorry, 95%. Did I say 75?
I don't know, 95. Yeah,
whatever. Yeah, sorry.
But is competition.
Yeah.
So basically, when I'm looking at a company, the main thing that I'm thinking is, why won't their why won't their suppliers charge more if they start to have good profits? Why won't their customers demand less if their prices rise?
Yeah.
And why aren't there ways to substitute the product between them or a competitor, like a substitute product or an actual competitor that does the same thing? And that's just the way you think right away. And so certain things jump out to you in terms of whether it's possible that you can keep making profits that way. Most companies are going to be, in my view, most companies are going to be undone not by mistakes that they make themselves or something like that, but simply just competition.
Sure, yeah.
They can't protect themselves from their microeconomic realities that they have. So you want to learn really quickly whether there's some stuff going on that protects them. And it's not fair, usually.
Yeah.
So companies will talk to you in a way that makes more sense with what they can control and stuff. But like I said before about like supermarkets or something, the best supermarkets are usually just those that happen to be in the best places in the beginning. There's some operational things, but you don't have to be the best operator. If you happen to have built a large supermarket over time in some place that got really built up, then you're lucky. So if you were one of the first ones to build one in northern New Jersey or in Southern California or something, you expanded it over the years, and now it's really valuable. Mm-hmm. If you did the same thing in Kansas, it's not. And you could be a better operator of a grocer in Kansas, and it would never have gotten to be a huge scale. You'd never make a ton of money on it. It's just the realities of where you were located and the scarcity of the ability to come in and compete with you because of restrictions on available land and stuff, And it's the same thing in a lot of these. If you happen to get the build up the first things that got network effects and things early on, then you can still have those advantages. And Buffett is that way with newspapers and things. He talks about survival of the fattest and all that. He can see very quickly that he bought into newspapers that he knew other newspapers in the town would end up out of business.
Was it Geico that he said I could give you? I forget the number it was, but like $100 billion and you couldn't replicate it. What company did he say that about?
I think he said that about Coke, probably.
Maybe it was Coca-Cola?
Yeah.
Yeah, probably was Coca-Cola.
Yeah, it's probably Coke.
Yeah.
And it's a good example because you have to recognize that when you learn about the company, whether that's likely to be true. There's, I guess, a lot of people like to use sort of theory sorts of things about Buffett talks in terms of moats. A lot of people sort of like to use economic theory, and we talk about that with like talking about whether what the company's barriers to entry are and barriers to exit. Actually, we were talking the other day about that, where I was saying one of the most important things in the industry is barriers to exit. People don't talk about it enough. We were talking about like steel. I was saying a huge problem is that they don't shut down this. That people won't shut down a steel mill fast enough, so you end up with too much capacity in it and things like that. And
could you explain that? Because I thought I've never heard somebody talk about barriers to exit, and we talked about
right. Well, barriers to exit are very important. And it has to do with cycles.
And what does that mean? Yeah.
Well, basically, what it means is that so you have this problem. You'll notice in general in business, one thing you should keep in mind is that like when you learn economic theory, they'll tell you that if a company can make a better return in something else, it'll get out of what it's doing now and go into that. Yep. In reality, that's not how it works. Companies will tend to invest more and more in the thing that they're already doing. So they'll try to make a good investment, but in what they're doing. So if they're a textile company, they'll try to make investments in textile stuff and things around it. What they should do sometimes is close stuff down. And when the example I was giving about a steel mill or something is they're not going to close it down as long as they get any cash flow coming from it month to month. It's only once they start bleeding cash, and in some cases they'll have to bleed cash for a while and believe it's going to keep happening before they actually will shut something down.
Yeah.
But they made a decision to build a steel mill originally. It looked smart. But for various reasons about cycles and things, they misjudged it. And now it's in a situation where it's earning a poor return on equity. Mm-hmm. To raise the return on equity for all the others in the industry, the thing to do is to reduce capacity that you have. So you should shut some down, right? But you're not going to because you're still getting money now because your sunk cost, right, that you had in it doesn't matter. So you're earning a poor return on that sunk cost, but as long as you're still getting some money from it, you're likely to keep it open too long.
Yeah, and I like the example because we were going through just cycles, and we talked, this was actually last night, it was like a long conversation. You were talking about chickens.
Yes.
And how they do it in the chicken industry. Mm-hmm. And do you want to explain that? Because I thought that was pretty interesting on like how they, I guess, try to control the cycle a little bit more.
Yeah, so we don't talk much about cycles here, but what I was saying is a cycle is always a timing thing.
Yeah.
So there has to be an imbalance, which has to be that someone misjudged something. So there's some reason why supply and demand are coming into balance, but it has to continue for a while, and the cycle will be worse the longer it continues. So my point was just that a chicken cycle is short because of the amount of time you have from when you have to breed more chickens, you have to hatch more chickens, to the time in which you're slaughtering them is short. So you're going to have a short cycle. And actually, there was an article in, I think, Bloomberg a while ago that really interested me. because it gave information about the idea that different chicken producers who sort of control the hatcheries, usually they don't own them, but they have control over them through contracts, were basically sharing data with each other. What they would do is they'd subscribe to the service, they'd provide like plant level data, which is crucial, and then they would, as a result, get the information from their competitors that way, which is sort of a way around. It's a way of trying to use like your saying that it's a freedom of speech thing, that's just a publication, but really you're colluding, you're sharing the data. Because if competitors in an industry like steel or something could all share their plant level data, then they could make decisions that would be better for them long term in terms of managing capacity and things like that. And so you could smooth out the cycle. And actually, the thing with chicken producers is that the inherent business economics are really good, but the cycle's really bad. So if you had one chicken producer that knew what they were doing in terms of controlling supply to match demand well over time to smooth out the cycle, then you could have really good returns, because it's actually a very nice business in terms of the product economics. It's just the fact that you have this really bad cycle in it, you know. And we talked about cycles in terms of what things would be really long and what things would be really short, and it's really a question of how quickly you can respond to that.
And obviously the chicken cycle could be really short, because like I guess the life cycle of an actual chicken is maybe a couple months, as opposed to pigs or whatever, where you raise them for, I don't know, 8 months to a year or whatever that is.
And so the important thing in terms of like making judgments about companies that way is the cyclical stuff actually relates very much to competition stuff. So the reason why that's happening is because of how quickly you can change your competitive situation that way. So how quickly they can increase supply or something. Whereas in some industries, you can't do it very quickly, and then you're much better protected. Now, over time, in some industries, although you can't do it quickly, you will do it eventually, and then you have these really big cycles that are bad, and that's a problem. But in other cases, you can easily predict it, and then you have much better returns. And actually, it's really important. I know people don't believe this, but non-cyclical type companies are going to vastly outperform cyclical type companies, other things equal. And I know people think, well, like they should, it's just easier, it's safer, whatever, is why non-cyclical companies are better. But it's actually because they can be more efficient, they can make more money just in terms of everything they do, because there's just less misjudgment that way. It's just the market for diapers is reliable in a way that the market for chickens is not, you know? And so it's just easier to do that.
Well, how so?
Well, because you're not going to have that same cycle happening. So, for instance, I don't want to get too complicated in terms of the market for diapers and stuff, but so market for diapers is very predictable year over year with population and things like that. Okay, fine. And then you have the issue, you also have certain other constraints, like you have shelf space constraints and stuff, right? So you have that. But you also have that in chicken. But a big difference has to do with supply, how quickly you can increase and whether you would. And I won't get all into it. Actually, my mom worked in serving the industry, the tissue paper industry, which goes into things like that. And there are reasons why they would be very slow to build a whole new plant and to do things like that. So they're not going to do that. I think I've given this example before, but there was, I remember very clearly that in the housing boom, there was a real demand for a product, a cheap way of making things instead of using better building material that could be used by getting paper companies to change over some production for you. And the paper companies were willing to change over the production temporarily to do it, but they weren't willing to build any plants to do it. And the reason why is that, unlike the home builders who were much less concerned about the cycle thing, the paper companies were very aware of what happened when you had too much capacity. Like it's sometimes in newsprint and stuff, they had way too much capacity. And so you have these really bad cycles where you have really poor returns for a long time. And so they wouldn't do it, and they weren't willing to build a new plant, even though returns were really great. And that's an example of like that cycle would have been worse if they had built it, but they knew not to build it. Whereas people who were building materials for homes hadn't seen enough cycles in homes. They thought, like a lot of people, that was a very reliable sort of industry, and they, obviously caused that cycle to be very, very bad. But that's the thing that you see when you look at these things, like talking about cycles, is because you should see in many cases, just by reading about a company, whether it's likely to have these kinds of cycles or not.
I mean, you could really, even by looking at the financials, right? If you see like the earnings per share just go like crazy one year, I mean, you could really see it from there as well, like the volatility in EPS.
You can, and that's important, except sometimes it's not visible in there yet, or like home builders is a good example or something. If you looked at the past, like anything related to home construction stuff that way, if you looked at the past, it would look much more reliable. but then you're going to have a future that was much worse. And home builders are pretty cyclical all the time, but some other things like we bought Hunter Douglas after the cycle, after its downturn and everything. It would have been very easy to misjudge that and to think that it wasn't very cyclical, because in the past it hadn't been very cyclical, but it was going to be because it was, having this crazy cycle, But of course, you could see it in that you had this sudden increase in your results.
Sure.
But that's the thing that people get confused about, is a lot of times when you read a write-up or something, people will explain that this is because of some permanent long-term change in the business or in demand for it in the industry or whatever, and you're thinking, well, is this really a temporary sort of thing? Yeah.
And then I guess to bring it back, right? So I guess a good way to disqualify companies that could be more cyclical in nature is to, I guess, do all the stuff that we look for, but also look for companies with, long-term contracts and stuff like that.
Sure. It can be.
You talked about, if there's serious competition, look for monopolies, duopolies, oligopolies.
Yeah. So a few things. One, which we talked about, is that you have to be much more careful about anything that will cause a big response either in the input or the output, which is so price changes, it's responsiveness to price changes basically. So if you're reading something and you think, if a small price change will cause a big change in behavior of my supplier or a big change in behavior of my customer, then I have to be very careful. So why you want to generally look for situations in which a change in the price of your whatever item you have is not going to cause a big change in the behavior of the customer. And sometimes it'll be things where you can't even really tell.
Yeah, we used the brand or the example of Hanes Brands.
Right.
We were talking about cotton.
Yes.
And then what do? They use that to make underwear.
Right, exactly. And there was a huge increase in the cotton price. And so the question would be whether that would continue and those sorts of things. And there was some concern from people looking at the stock. It might just be short-term concern, but it was just concern that, okay, well, prices of cotton go incredibly high. Doesn't that mean that these companies are going to make a lot less money in the future? And I would say, no, it doesn't. It doesn't really make a lot of sense. They'll switch to using something else, or cotton prices will go down, or both things will happen. But the things that they're doing there's no reason why people need cotton to be the thing that underwear is made out of. There's plenty of other things that you could get it from.
Sure, yeah.
And the main things that they're doing are not really that much tied to cotton. Now, if you're a cotton farmer, then yes, the cotton price matters a lot. But this is a temporary issue, and then you should have looked at it and seen that it's a temporary issue for a clothing manufacturer, something who's using cotton, to have that problem. There'll be other ways around it. If the world suddenly ran out of cotton, it's not like all underwear making companies would go out of business. They would figure out a way to stay in business, and their economics probably wouldn't be all that different.
Totally. Yeah. So let's go to the 5%. And everyone listening, we have zero agenda when we do these podcasts. We know the title, and we just say we're just going to go down a bunch of different rabbit holes, which is great, I think, because it produces a good show. So that was interesting, but I just thought I should say, we don't script any of this. We know the title, generally what we're going to talk about, and we just kind of let it flow from there. Right. But okay, so let's go to the 5%. How to quickly, I guess, look at something that is interesting, where you're going to say, okay, we should probably look at this a little bit more. What is that? For you?
So like the ones I just said. So let's think in terms of suppliers, competing products, and substitutes and competitors, and then also your customers, right? So any product where if you raise the price on your customer, they wouldn't respond much in any way. That's something that if you see that's something you circle in the 10K.
We're almost like they're forced to continue doing business.
They might force to be continue doing business with you, or it's such a tiny amount of the end product, or especially things where it's this tiny amount of the end product and they think it's important for them. And the best thing is when when it's basically ineffable in some way. It's hard for them to quantify the benefit that they get.
So
from
it's almost like a byproduct of it.
Well,
we talked about this yesterday with GraphTech. Mm-hmm. So maybe explain what you mean by where it's such a small percentage.
So in the case they were talking about with GraphTech is that what they make is a product that steel companies would need to buy to keep their plants running, and yet the report that was written up about it was saying that it's even at very high prices only about 5% of the total cost of the steel that will be produced using it.
Yeah.
So it's not a big factor, and yet it would stop the production of steel. So you would think that the buyer would be relatively insensitive to price increases up to the point where actually it made sense to shut down production or something, which would be an incredibly high point. So that would mean the price could keep going up for a long time and it wouldn't stop them. There are other products where that's not true. If it's a really, if you're taking a product and 80% of the cost of what you're going to manufacture from it is what they're buying from you, right? If they're basically just refining it a little bit and then selling it, then they're going to stop very fast if there's any increase in the price of the product. Yeah.
Got it. So, okay, so 5% of the things that or qualities you look for the 5%.
Yeah.
Okay.
So that's one of them. The other
Yep.
one would be if there's no substitute. There's no other way to do what they're doing.
So they own the market type of thing?
It's a monopoly type thing. Yeah, sure. So, and they don't have, there's not realistic competitors. I've talked many times about like BWX Technologies. Looked at that, thought about, are there realistic ways to power things like submarines and aircraft carriers without using nuclear? Not really. There's no one in the U.S. that's a reliable alternative to Babcock, to BWX Technologies. And then, are you really going to buy from someone, if there was you could have a competitor that if they were supplying another nuclear navy, but if the U.S. was using a supplier and China decided they want a nuclear navy that was using one supplier, would they really both use the same supplier? And my thought was no, they're never going to do that. So for security reasons and stuff. So I just thought that it was very safe that there wasn't a substitute that way. And many of the companies we have work that way, where we think that a company would be fair, that they're unlikely to substitute is an important part of it. If they're very likely to substitute, that's very scary, and that's most companies. Mm-hmm. It doesn't take much to get a competitor, to get a customer to buy something else. And that's really big when it's like a transactional type thing. So you were talking about like contracts. Contracts are great, but even better than contracts are habits. So if someone is habitually buying something without thinking about it every time they go to the store or something, that's like better than a contract,
Even, I guess, relating it back to Graph Tech, in that report he had wrote up, if they cancel those contracts, whatever, they would be, it's like a 60 to 7%.
Very high
contract termination fee.
Yeah, absolutely.
So you kind of create inertia in that.
Yeah, and that was also an indication there where the customers are happy to agree to a fixed purchase thing, where they would, for a few years, they wouldn't be able to raise prices right on them, but they would have to buy that. Like I mentioned, George Risk, that similar thing happened in, not that George Risk promised a certain supply or anything, but they've raised their prices after not raising them for a while, and their biggest customer, I assume it was the customer that asked for it, not George Risk, asked them to sign an agreement to fix the price for several years out, which can be an indication when a customer is eager to do that you have a lot of pricing power and stuff.
Sure.
Because the reason why I suggest that is not so much that they're trying to control the price. It could be. Like those companies could have been, I'm worried the price will go even higher, but I don't believe that. What I think they were really doing is trying to make sure they had a secure supply. And I think that was the same case in like George Risk and stuff. They became concerned that they might not have a constant supply of something, or that the price could keep getting raised on them a little bit too. But yeah, whenever they're eager to sign that sort of deal, and we've had many things that have contracts, but yeah, brands and things are just as good that way in terms of if someone keeps buying them just out of habit.
Yeah.
The things that we've talked about before that you don't want are things where the customer is very well educated about it. They think a lot about it. They can say no for a long time before buying it. They can put off the purchase, whatever. I mean, so there are companies that have very strong competitive positions in like washing machines and stuff. But washing machines are a worse business than chewing gum for the reasons that I just explained, which are like the extent to which someone thinks about the competing products and the substitutes and things like that for washing machine is just really high. Versus they just don't think at all about what price they're really paying for gum. They don't compare across, like if I buy a lot of gum here, if I buy a little bit here, what am I doing? They don't know how much gum they're really chewing. They don't think that much about the competing products or any of that sort of stuff. They just, once they start doing something, they think, this is pretty good. I'll just keep doing it. They don't even necessarily think it's the very best.
Yeah.
But it's good enough. Whereas with a washing machine, they take a lot of time to think about it and to make the decision.
Do you think that's because it's a larger purchase?
Yeah. It's a larger and less frequent purchase, and that's the problem. Larger, less frequent purchases are usually much worse.
It's kind of like cars, for example.
Yeah, and we've talked about that. Car dealers are a horrible business except to the extent of everything around it. I mean, car dealers only work because for various reasons, they have a very low cost of capital. They're manufacturers of cars, car makers, need to push the product out. And so they do certain things to help the dealers, basically. Yeah. And there's some other things related to that. And you also have good collateral in cars that it's going to be turned into cash pretty quickly and stuff. It's easy to borrow against. So their financing is cheap. So that's their one advantage. And then the other advantage that they have is that once they get you there to talk about an expensive car that you want to leave with, if they keep you there for a while, they can then sell you a warranty. They can get a commission on a loan. They can get a commission on insurance things. They can get all that. And that's going to produce a lot of their profit. And in many car dealers, that's going to be half their profit, their gross profit or something. If you do the math, without that, they would be running a EBIT loss that's pretty meaningful.
Yeah.
So their entire return is coming from selling that stuff. If they just
it's like cross-selling and like the services and everything that comes from the dealership.
But it's a big advantage that they have because you came to buy a car, you were focused on the car, and you became reluctant over time to walk away from a deal. Yeah, and then you became more susceptible to take little add-ons and things that seem small versus the price of the car, and that can be more complex, less transparent, things like that.
Maybe we should do a podcast on all the dealerships.
Maybe, yeah. But yeah. So, but when you read about it, that's part of the problem, because like when you read about a car dealer or something, you think, oh, this must be a really bad business right away. I mean, you think about that if you think about how it really works. But as you learn how it works, you think, okay, well, you pick up those sorts of things, and that's how you can make a judgment about it. Yeah.
And then also people should go back to our 10K video and listen to when you describe the business section. Yeah. Because the things that Geoff, that you look for to really tell you a lot about the business. If we compete on price, okay, then that's probably may not be a thing that, you want to go into. It really, they should really lay out, their whole business in there, and just the little nuances, I guess, that you look for that tell you all, like, give you the big picture, I guess you could say.
Yeah, and you should do what Buffett does, which is he wants as much past financials as possible, and then a description of the business. So go to someplace like quickfs.net, go someplace where you get the 10-year financials, see them, and read the business description. Yeah. And those two things together, in a lot of cases, you're going to be able to tell whether it's one of the 95% or the 5%. You won't come to a final decision, but you can sort them into those two groups.
Cool. Well, I want to thank everybody so much for tuning in with Mr. Geoff and myself. We are going to be in New York, like I said, November 11th through the 15th. So if you're interested to learn more about our managed accounts or the fund that we are launching, reach out to me, info@focuscompounding.com. Be sure to hit that subscribe button, follow along, thumbs this video up, leave us a rating review, check out all of our other content. I want to thank everybody so much for tuning in with Mr. Geoff and myself, and we will see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.